Yeah, again, net profit before tax and extraordinary items. If surplus, that is balance in statement of profit and loss is given. That means in simple terms they have given balance sheet. Balance sheet. So here first we are going to take surplus that is given in statement of P&L, or surplus that is statement balance in statement of P&L. Closing minus opening, that is nothing but current year minus previous year. If you are given 23, 24, so 24 minus 23. Now add, what are the things? That is again saying, if provision for tax is given in current liabilities, provision for tax, which year? Current year again, current year, but this time 2 years information will be given. As balance sheet is given, will be given previous year and current year. If 22, 23 is given, so 22 is previous year, 23 is current year. Next, plus transfers to reserve. Now I told you, transfers to reserve. Sometimes what will happen is, you will be given surplus that is balance in statement of P&L and notes to account. So whenever balance sheet is given, notes to accounts will be given. So surplus that is balance in statement of profit and loss, you will be given in balance sheet, previous year and current year, and down they will give you reserves, general reserve, reserve fund. Securities premium, if it is there, it will go to financing, but only reserves, that is general reserve, reserve fund, if it is given. So difference of that two, that is previous year and current year difference, that is considered to be transfers to reserve. That also we are going to add it separately. Your surplus that is balance in statement of profit and loss, closing minus opening, and then transfers to reserves. Then we add proposed dividend, which year? Same thing, proposed dividend of previous year. Then we add final dividend. Now final dividend, be careful, sometimes proposed dividend is given, dividends paid is given. So dividends paid is given, 1 year information, that is considered to be your added in your first step of cash flow statement for calculation of net profit before tax and extraordinary item. Same thing is deducted in the financing activity. Plus interim dividend. Mind you, interim dividend, they won't give you 2 years, but sometimes if they give 2 years, always interim dividend is paid in between two balance sheet dates, and it is paid to equity. So whenever interim is paid, you need to pay preference shareholders as well. And interim dividend of current year, usually if 1 year information is given, it is assumed to be current year paid. So then in that particular year only interim dividend will be paid. So always think, if previous year, current year both are given, only current year you are going to take. Only current year you are going to take. Interim dividend of current year is to be added. Then we are going to subtract. Same like income tax refund. That is in brackets I am putting, that is indicating it is to be subtracted. Then less your claims from insurance company. That is to be again deducted. Whatever balance which we get, this is considered to be your net profit before tax and extraordinary items. Step 2. Now we need to go ahead with calculation of operating profit before working capital changes. Working capital changes. Now this part onwards, that is step 2 onwards, we can take it in cash flow statement. And first we are going to take up your, as per step 1, that is net profit, or first we'll write cash flow from operating activity. Cash flow from operating activity. So net profit before tax and extraordinary items, which we did it in step 1 and step 2, that is net cash flow from operating activity. Step 2 onwards we can take it in cash flow statement. If there is no extraordinary items and all, if only directly surplus, that is balance in statement of profit and loss, you will do surplus, that is balance in statement of profit and loss, closing minus opening. Or if extraordinary items are there, net profit before tax and extraordinary items, as per you can write step 1. Then we will add. Now step 2 starts with calculation of operating profit before working capital changes. That is, we are going to add non-cash, non-operating expenses. Non-cash, non-operating expenses. That is, we'll take depreciation and amortization. We need to add this amount. Then we are going to add loss on sale of asset, loss on sale of investments. Next, we are going to add your interest paid. Now interest is paid on borrowings or on debentures. Of course, just like your proposed dividend, this interest paid on borrowings and on debentures will again go to financing activity. Next, now for subtraction, we are going to take non-cash, non-operating incomes, non-cash, non-operating incomes, that is gain on sale of asset minus rent received, comma dividends received. Now loss on sale of asset is added or investment is added, but gain on sale of asset, gain on sale of investment is deducted. Rent received, dividends received are deducted. Now there are chances where, sir, loss on sale of asset which I am talking about, it includes both tangible and intangible. And here also gain on sale of asset or investments when I am talking about, it is tangible assets and intangible assets. Now once if you add and deduct the total amount when you get it, this addition and deletion of these two items or this non-cash, non-operating expenses are added, non-cash, non-operating incomes are deducted. This final amount, either it can be deducted or added. Whatever balance which we get, it is considered to be calculation or it is considered to be operating profit before working capital changes. Operating profit or the balance which we get, operating profit before working capital changes after addition and deletion of this. I hope you have understood. I am explaining the format as such. Coming to non-cash, that is operating profit before working capital changes, which I am talking about. This is telling you that there may be, I have one student or few students ask me, sir, we get a negative balance. Let us say this is 1 lakh and this is coming as 1,20,000 negative. That is your minus is greater than your plus. So you are getting negative 20,000. Still you consider as operating profit before working capital changes? We write the statement as operating profit before working capital changes, but we write it in bracket. That indicates it's a loss. But we don't write loss before working capital, operating loss before working capital changes in the format. Now we are going to talk about cash flow from operating activity, which for making it easier are divided into 3 steps formula based. Okay, maybe different from different teachers to different teachers. To make it feasible, I have divided into 3 steps. Step 1, that is nothing but your calculation of net profit before tax and extraordinary items. So in this case, we need to check out what is given in the question. Is it net profit after tax given to you? So if net profit after tax is given, we are going to find out net profit before tax and extraordinary items. For that reason, we are going to take, that is, if net profit is given in the question. So your step 1 will be net profit. This we can show it in working notes. So net profit after tax, whatever is the value given. To that, you are going to add provision for tax of current year. 2 years information is given, that is 2022-23, let us say. So 23 is current year. So whatever provision is given, you are going to add that. Then you are going to add proposed dividend. Now which one proposed dividend? Proposed dividend of previous year. Now why previous year and why current year? First of all, current year provision for tax. The reason is you are not going to pay this year. This is not resulting in outflow of cash. This is created prior to, or it is a future related thing which we are not paying, not resulting in outflow. That's the reason we are adding. Proposed dividend of previous year, we are assuming whatever proposal which you have made last year, you are paying it. Sir, here we are paying, but it is not relating, it is outflow of cash flow, sir. Yes, but it is not relating to the operating activity. It is relating to financing activity. So this has a second effect, that is we are going to deduct in financing activity. But as we have declared it from profits, we are adding back to the profit to purely find out what is my operating profit. Then we add your any abnormal losses. Now what are these abnormal losses? Losses which are not controllable, which is not in our hands, like loss due to earthquake, loss due to fire accident, or natural calamities. So these are the things added. But this is not in our hands. So this loss occurred. Because of that, it is not the outflow of cash or loss due to day-to-day activities. It is beyond our control. So that's the reason we add back. And we are adding back because it's an extraordinary item stating that it is not relating to that particular profits of day-to-day activities. Next, less income tax refund. Income tax refund. Income tax refund means, let us say you have paid tax more, and as per the assessment of the tax authorities, they found that you have paid more, because as you are creating provision for tax prior only, for future tax you are creating a provision now. So you have an habit of creating or expecting the profits and you create a provision, and you have paid extra last year. So in that case, they are refunding the tax to you. Refunding the tax to you. So that is to be deducted. Next, you are going to deduct the claims for losses given by insurance company. Insurance company. Insurance company. This is we are going to take, or this is we are going to subtract, and whatever end balance which we get, that is considered to be your net profit before tax and extraordinary items. Yeah, children. Today we are there cash flow statement, to learn about the cash flow statement, specifically about the operating activity. Specifically about the operating activity. But before we start with operating activity, what is cash flow statement? Cash flow statement is a statement which explains about the inflows and outflows of the cash from three activities. One is operating activity. Second is investing activity. Third is your financing activity. Financing activity. Let me explain about these three activities. Operating activity. Purely in cash flow statement, we are going to talk about the inflows and outflows of cash and cash equivalents from day-to-day activities. So we are going to exclude, there are certain extraordinary items, there are certain other incomes or other revenues which has been there, which are relating to investing and financing. We are going to exclude, and we are going to basically take inflows and outflows of cash from operating activity. Investing activity. So children, one thing I wanted to know, that when we talk about investing activity, basically I'm talking from trading unit point of view or non-financial companies point of view. So non-financial companies usually require capital. What do they do with that capital? They invest. Where do they invest? On the non-current assets part. Non-current assets part. So basically the investing activity consists of the inflows and outflows of cash. Inflows and outflows of cash from the non-current assets. That is investing on tangible assets, intangible assets, and the investments made during the year. That is in the other businesses as well. Now, coming to financing activity. Now, what are my sources of finance? If you talk about non-financial companies, there are two sources of finance which we have. That is owner's fund. That is owner's fund and borrowed fund. Borrowed fund. So specifically when I talk about owner's fund, in case of companies, owners are my equity shareholders, preference shareholders, and then when I talk about borrowed fund, it is my non-current liabilities I am talking about. Non-current liabilities I am talking about. That is your loans, comma, your debentures, any borrowings which is beyond 12 months period, that is considered to be my non-current liabilities. So any inflows and outflows relating to this owner's fund and borrowed fund will come in financing activity. In financing activity. Sir, you can tell this as shareholders fund. No sir, we can write shareholders fund entirely goes in financing activity. No. There is one thing called as reserves, which is excluded from shareholders fund. Basically, we are talking about equity and preference. No doubt securities premium reserve. Securities premium comes under reserves and surplus. But that reserves will come in financing only. But in simple, general reserve is given. Transfer to reserve is given. That reserves is not a part of this financing activity. So that's the reason I cannot take shareholders fund. So shareholders fund is nothing but your equity plus preference plus reserves and surplus. Is it clear? Am I clear? So what is cash flow statement? Finding out the cash inflows and outflows from operating activity, investing activity and financing activity. So what are these? This is the broad outlines I gave. This is from the non-financing company's point of view. Financing company's point of view, the shares, preference shares, the buying of shares, the selling of shares, the interest received, dividend received becomes a part of operating activity. And their investments will be in what? Their investments will be in the equities or whatever they are selling as such. For financing institutions, your financing activity will be considered to be your sources from where you are getting this finance as such. Is it clear? So talking about these three activities, the cash flow statement basically speaks about the inflows and outflows from day-to-day activities purely. So for that we need to exclude. So please keep on watching for the next videos for individual activities I am going to explain.